You're listening to the Uptime Wind Energy Podcast, brought to you by BuildTurbines.com. Learn, train, and be a part of the clean energy revolution. Visit BuildTurbines.com today. Now here's your hosts, Alan Hall, Joel Saxum, Phil Totaro, and Rosemary Barnes.
Welcome back to the Uptime Wind Energy Podcast. Joel Saxum is in Australia. You want to tell everybody where you're at the moment?
Yeah, we're down in Melbourne. I'm here with Matthew Stead from Ping as well. Rosemary was supposed to join us, but of course she's under the weather. But we are down here doing basically a tour to Melbourne, I guess you could say, of the wind industry. So if you don't know, in Australia, a lot of the wind operators and ISPs and OEMs, to be honest with you, are located here in Melbourne. And we are talking to them all about the conference that we're going to put on this February. It is the new and improved version of the successful one we did last year. So we're taking the feedback that we got right after the event last year, connecting with these all the stakeholders down here and seeing what do they want to hear for the next one? What did we do well? What could be better? We're looking at venues. We're doing kind of all the above to get this conference up and running. And I know Matthew and I think we've had 4 to 5 meetings a day, every day. Thank you to the people that we've met with, if you're listening, because it's been really good for us, very engaging, lots of feedback. So I think we've got a good list of speakers lined up, and then also content for next year.
That's great.
So what we're looking at right now as well, if you're inking this on your calendar for the Wind Energy O&M 2026 conference here in Melbourne, is February 17th and 18th this year. We're going to do 2 full days of panel discussions, round tables, and all kinds of information sharing. The goal, of course, just like last year, gather up some of the smartest people in wind and share strategies that you can take back for operations and maintenance and action within your company.
And Phil Totaro of IntelStores out in California. And Phil, this has to be one of the busiest weeks in wind on the investor side. So much happening. Ørsted is going to issue a $9 billion emergency fundraising round. And I want you to frame this a little bit. I've heard so much on the news and been reading a lot about this, but there's several undertones, several things happening at the same time, and there really hasn't been a clear path as to why Ørsted has decided to go forward on this fundraising round.
Well, effectively, it stems from 2 big things. One is obviously they had shown some financial losses recently, and this is going back a couple of years now, that had necessitated, companies like Equinor coming in and taking a 10% stake just to bolster them. Again, we talked on the show before about the fact that they're not necessarily wanting to take over, although now there's some people in, Denmark that are kind of pushing the Danish government to sell off their chunk, and the presumption is that it would be sold to somebody like Equinor. So we'll still see if that's possible or even, likely to happen. But there's a project here in the United States called Sunrise Wind, which Ørsted was hoping to sell off a chunk of to a co-investor. And because of some of the rule changes around tax credit qualification, they're probably not going to be able to move forward in the way that they had hoped to with that stake sale. And as a result, it's leading them to absorb a lot of the, financial losses from, some of the delays and other issues that they've had with getting a lot of these offshore projects, up and running. It's kind of forcing them to do this capital raise to be able to provide themselves with enough cash to be able to continue operating.
The Sunrise Wind project was a partnership between Ørsted and Eversource, and Eversource pulled out of that roughly a year ago. And the other one, which had a partner that Ørsted had who pulled out, was for Ocean Wind 1 and 2, which was PSEG, which is a New Jersey power company, Eversource being a Northeastern power company, essentially. Those 2 pulled out like in 2023 and 2024 when the price of steel went up, inflation was high, the cost of the projects went up. So they've been out for a little while still. Was it in that interim that Ørsted just wasn't able to find anybody to join in on those projects? And it does seem strange, and I want to get to this point. All the U.S. investment in offshore, all the U.S. companies are all out. Basically, you have Equinor and you have Ørsted.
Dominion.
Oh, Dominion. Okay, that's true, but Dominion is sort of a different animal.
The reality is yes, is the short answer to your question, Alan, that they had tried to find another co-investor after Eversource pulled out. The challenge with that was that there has also been an effort by the project developers to try and renegotiate the PPA prices. Eversource was going to be one of the main off-takers for this. They don't want to have to absorb a significantly higher price and then have to find ways of passing that on to customers. And it's also what led to this challenge of Ørsted not being able to find a new co-investor after Eversource pulled out. With interest rates being so high and not being able to renegotiate the PPA anymore, the developers that are still, have their lease areas and are pursuing their projects, they're locked in to whatever they've got at this point. If nobody else wants to come on board, then it's up to Ørsted to basically eat the entire cost of this thing, and thus, a major contributor to the capital raise.
So the discussion online is that the Trump administration sort of forced this to happen. That isn't necessarily correct. I think a lot of this has started a year or two ago. You remember also, Phil, with Ocean Wind 1 and 2, the exit fees with the state of New Jersey. I think that Ørsted was going to have to pay somewhere around $300 million to the state of New Jersey, and I think they ended up paying less than half of that at the end. But it's still a lot of money. There's a lot of money in exit fees that Ørsted has paid over the last 2 years, roughly. Or buybacks. They paid Eversource to get out, essentially.
Just to also clarify, what the administration's done has not helped. I think we can all agree on that. But the reality of it is that, yes, they were already in a bad situation that got made even worse by increasing the risk of, particularly a foreign investor coming in and being a co-investor in this project. Obviously, there are any number of utility companies in the United States that could have, co-invested in this project along with Ørsted. They chose not to because they don't like the economics of offshore wind. And that's just the reality at this point in time. I mean, Duke Energy this week, or I guess last week as this episode airs, also just announced that they're going to cancel their 2 North Carolina projects because of the same thing. It's basically down to the economics of the project. And at the end of the day, if you've got somebody in the administration that's making, the investment environment look even worse than what it already was before he even came into office, then it's going to necessarily, take more options off the table for, potential investors that could have come in and at least helped kind of share the risk and reduce the amount of capital outlay that Ørsted would have had to make just by themselves.
In my mind, with this new kind of like PTC, ITC cliff coming, there's no reality where capital gets cheap enough, interest rates get low enough in time for any of that to change. Like that's just not going to happen. We've got 18 months and it would have to come down by percentage points, not basis points. And I don't think there's no reality of that happening.
I think that's true, generally speaking, right? But I think the problem is where are the New Yorks and the Massachusetts of the world going to be able to get power from? They need this. They really do need offshore wind. And the prices of electricity there, if you're a consumer, is about $300 a megawatt hour. That's what I was paying in Massachusetts to buy power on the grid. So $150 a megawatt hour coming off of the offshore wind farm, wholesale still is high compared to other parts of the United States, but it's half of what I was paying as the consumer. So there is a dichotomy there, right?
Yes, but keep in mind that's only for the generation cost. So where I am in California, I pay basically $380 a megawatt hour for electricity as a consumer. Now, half of that is generation. The other half is split between the transmission and distribution cost plus the overhead to Southern California Edison as the utility. And the reality is that, yes, the generation cost may be $150, but they're still going to have to raise prices for consumers to be able to sell them the power, because you have to factor in the transmission and generation cost, and they're going to want to maintain at least a 20% overhead on all that, and because that's literally their profit margin.
Well, Phil, what I'm trying to get at is the other half of the equation, the transmission distribution piece, is not cheap. And so we force all the generation side to be as low as possible, but the people in the middle, it's the middlemen, as they would call it, are taking a substantial amount of the money that you're paying for electricity today. So yes, offshore wind is expensive, but so is transmission and distribution. And you would think something that's been around for 30, 40, 50 years, transmission and distribution, most of it in the United States has been around at least that long. You think that the cost of that would come down over time, and it really hasn't. Which the economics doesn't make any sense about that. And so when we're talking about Ørsted, like, yeah, all this is not great for Ørsted, but there is something wrong with the system where Ørsted can't make this work.
Yeah, which is also why we probably shouldn't have the government canceling transmission projects, because we need them. And taking, $700 million plus out of the Department of Energy's grant budget for transmission projects. I mean, this is a time when we need a lot of that technology, but because it has any association with wind and solar, it's getting pulled. So, that's a decision that's been made by the DOE.
Phil, and about this one up, I saw this just yesterday, I think. There was like double digits coal projects pushed forward. I don't know if you saw that. There was a press release where there was like something like 11 coal projects or something like approved to move forward, and it's like this is yesterday's technology. We're moving forward. Why are we pushing coal? And there was a guy on Fox News talking about it, and they were saying like, well, have you made strides for coal to be cleaner? Because of course you have. And he was like, well, there's always going to be a footprint. Like there was no like, yeah, we've done this clean coal thing. It's like, because Trump, talked about it as clean coal. And they were like, well, it's coal. There's always going to be a footprint with mining. So yeah, that's our reality.
Are we still going to dig rocks and then burn them? Is that the plan? Because it does seem a little bit easier to take the wind and turn it directly into electricity. Same for solar. Turn the sun into electricity without having people digging rocks and moving rocks and transporting rocks and trails to rain and fires and the whole bit. It's insane right now.
Well, for those that also don't understand, wind and solar, by the way, contribute $3.5 billion annually to lease payments to landowners directly and to state and federal tax coffers. So, you want to explain why that's not worth something. I'm prepared to hear it as an American citizen. You can also explain to me, if you're the government, why you're canceling lease auctions at BOEM that would have generated $1.8 billion for the federal government. That's revenue that you're literally throwing away. Even if you don't like wind, you don't want to see it. It's not like it was going to get built during, his presidency anyway. Why not at least take the money? And then the project developers can go build it, which, by the way, they're going to do anyway. They can just go build the projects after you leave office. So, you know what? You can't paint yourself as being pro-business when you actively turn away money.
Don't let blade damage catch you off guard. Eelogic's ping sensors detect issues before they become expensive, time-consuming problems. From ice buildup and lightning strikes to pitch misalignment and internal blade cracks, Eelogic's ping has you covered. Their cutting-edge sensors are easy to install, giving you the power to stop damage before it's too late. Visit eologics-ping.com and take control of your turbine's health today. So Joel, watching the Ørsted stock price once they announced this new stock offering, it plummeted about 30%. And plummet is probably a pretty good word. I've used the word cliff to describe the drop-off to Rosemary the other day. It dropped a ton. And it hasn't, I went back and looked at like the 10-year on Ørsted stock. It was doing great in like 2020, 2021, just after COVID, and it's come down quite a bit since then. But Ørsted as an organization is still making money. They're not making money as fast as they were before, but they're still making money. What does this really mean in terms of the long-term outlook for Ørsted?
Well, I know it's got the industry a buzz, right? I think I woke up, of course, I'm in Australia right now, so the time zone's a little weird, but I woke up with a large handful of messages from friends around the world. Did you see Ørsted's stock price? Did you see Ørsted's stock price? I think that, we know the situation. We've talked about on the podcast a lot about what's going on in offshore wind and the impairments on projects and the difficulty in financing and kind of the headwinds that they've been facing Ørsted as a whole. At the end of the day, you can see, because this is my take, I'm not an economist, but when I looked at how the stock price fell and then it flattened right off, right? It was like, cliff, and then straight off. I was thinking, okay, this is institutionalized money that understands what's going on here. And you lower that price, then there's the stock offering. So there's a cheaper way to get into Ørsted here. I don't think it's going to affect the long-term outlook of the company, right? Like the immediate stock share price dropped like a third. That sucks, right? But it'll come back. I think, if you look at like what you said, the 2020 on trend, that trend follows a lot of other pure play wind companies as well. I mean, I guess I would consider Ørsted a pure play wind company, even though they're probably 90%. Right, because they dabble in some battery stuff and V2X stuff and some hydrogen, whatever. But they're a wind company. And if you watch the trend of other companies in the same space, like they've been getting beat up for the last 4 or 5 years during this COVID play, or since then. So I think that, again, the long-term run for them, they'll be healthy. They'll come out of this. They'll raise some money, make some moves with it. I don't think it's going to be a big issue.
Phil, same thought? Is it going to be a big setback for Ørsted, or are they going to need to try to sell off some assets? Because that's the talk around the industry, is that they're going to do this fundraising effort, but at the same time, they're going to try to offload a couple of projects or things that have value today to improve their long-term forecast.
Yes, and I would concur that that's likely, but that's also not to freak anybody out, because companies normally do this kind of what they call an asset rotation. Up until now, particularly with their offshore portfolio, they've owned almost 100% of most of their projects, and it's only been in the past 5 years that they've even been adopting the philosophy of going in and getting investment partners to come along with them, and it's also something that's been possible through the capital markets as well. The problem for them is that they negotiated poorly probably about 3-4 years ago on some of these contracts that they worked out, particularly for the power offtake in places like New York or New Jersey, etc., that led them to these big fees for pulling out of projects and cancellation fees, et cetera, that, left them with a lot of debt and other kind of cash-related liability on their books. So the capital raise is necessary. The project, asset sales and things like that, the asset rotation that they can undertake, that's also necessary in all likelihood. My concern for Ørsted, the bigger concern here, is whether or not they are really going to keep flowing cash into potentially unprofitable ventures.
Are you worried about unexpected blade root failures and the high cost of repairs? Meet EcoPitch by Onyx Insight, the standard in blade root monitoring. Onyx's state-of-the-art sensor tracks blade root movement in real time, delivering continuous data to keep your wind farm running smoothly and efficiently. With EcoPitch, you can catch problems early, saving hundreds of thousands of dollars. Field tested on over 3,000 blades, it's proven reliability at your fingertips. Choose EcoPitch for peace of mind. Contact Onyx Insight today to schedule your demo of EcoPitch and experience the future of blade monitoring. TPI Composites, which controls about 25% of the global wind blade market, excluding China, of course, has filed for Chapter 11 bankruptcy with liabilities somewhere between $1 and $10 billion. They weren't very specific in the filing. There is a lot of questions about TPI at the minute because they have an order book and they push out like 6,000 blades a year, something around that number. Oak Tree Capital has come in and has backed them. Chapter 11, if you're not familiar with bankruptcy methods, Chapter 11 allows you to continue to operate and reorganize and restructure your debt. Chapter 7 and some of the other ones are pretty much an immediate shutdown. So TPI is going to continue making blades or getting some funding. But Joel, this is actually a big hit to the GEs of the world who rely on TPI to produce blades.
Is it though? Right, because you usually in Chapter 11 you usually have like a tiered debt structure too, right? There's Class A, Class B, Class C, right? So their debt to a TPI is normally going to be raw materials, logistics, those kind of things, unless, and I don't know how they do their business, right? There may be a case where, like, because TPI does a lot of work with GE, right? They may have GE may be doing the logistics on their end, so that might not even be on TPI's side of things. So it's like building rent, capital assets. So if they have loans out against buildings or some things like that, right? Those are usually Class A type things where they get paid off first. It's a little bit rocky, but they're able to continue work, right? So there'll be some changes, but it shouldn't upset the wind industry. Like, it shouldn't upset the supply chain.
Well, it does introduce another layer of bureaucracy because once you enter into Chapter 11, you can't buy supplies, you can't sell things as easily. It becomes much more transactional. You have to have approvals, so you can't start selling off assets behind the scene. Chapter 11 is a very structured environment that you have to operate in. You don't want to be there if you can avoid it because it just makes things harder to do. But at the same token, and Phil, maybe this is where part of the problem is, they have plenty of orders, but are they getting paid on time? Which is my first question. Have they been getting paid when they should be getting paid? And then second, has quality issues about a year or two ago sort of stacked up where they've had to do warranty claims and spend a bunch of money that they weren't expecting to? Is that what led to this eventual Chapter 11 filing?
Yes, all those did contribute. They also had issues and unexpected costs associated with their expansion. They had some strikes in Turkey where people wanted more money. There were any number of things that occurred. But I want to go back to this notion that they have up to $10 billion in liability on a company valuation of, what did you say before, Alan? It's like a few $1 million.
Market cap right now for TPI is $7 million.
And that's down from $100 million a couple months ago.
That's extremely concerning, considering the fact that they have such a wide range, between 1 billion and 10 billion. And secondly, that obviously stems from the quality issues that go back a number of years. See, I mean, I remember us talking about it a year or two ago on the show about how they've brought, quality experts in, manufacturing head, chief technology officer, even the CEO got replaced at one point because of some of the quality issues that they had and how it was being handled by the previous management. So presumably this is part of a strategy to, again, restructure the debt, certainly, but the liability issues could still persist. Because even though, you're getting bankruptcy protection in Chapter 11, nobody's going to want to come in and buy the company anyway. If they had entered Chapter 7 where it was a liquidation, then that's a scenario where you could have, I wouldn't necessarily say it would have been GE Vernova comes in and buys them, but it could have even opened up the opportunity for, a foreign company to come in because their factories already have tax credit qualification. And so somebody could have stepped in and taken that over. But this is just the recognition that, okay, if they're in Chapter 11 and they're restructuring their debt, it doesn't mean that the debt goes away. It might get reduced. And hopefully it gets reduced if it's $10 billion. But because that's literally almost their entire fleet of blades would need to be replaced.
Yeah. And Joel, I think this is the real crux of this is you can't have $1 billion in debt and operate a blade factory. That doesn't make any sense. Do they eventually clear this out? What do you think is going to happen to TPI? Do they just continue to operate? No one has any interest in it. They just continue to make blades and bring in some revenue and restructure the debt. I don't see this ending well.
Chapter 11 sometimes is a gateway drug to shutting the doors.
Yeah.
That could be happening, and then it's fire sale because then the lawyers step in, and there's oversight there, and someone could pick up the assets, or the assets get parted out to try to pay back the debtors or the creditors. Sorry. So you could see other blade companies. You could see something odd, a Sonoma and Aris, or of course I don't have the insight into those as much as maybe Phil does, but you could see someone else buying this assets.
Yeah, it wouldn't be Sonoma right now because of the foreign ownership thing for the tax credit qualification, Joel. But there are, you mentioned one company that could be interested and has expressed interest in, getting a footprint in the U.S. But there's also companies, in other parts of the world that want to have a presence here in the States that wouldn't necessarily be subject to, the foreign entity qualification restrictions to qualify for tax credits. So there are possibilities for this long term.
Does it leave a door open for a company to come in and clear the books, settle the debts on some level, and then you continue on as a restructured company?
Or think about this one, and this is a long shot, right? But does it leave a door open for someone to watch TPI fall on their face and start up a blade company?
I don't think so. That'll be hard because there's so much momentum right now with TPI. It'd be really hard to do that. Be like, I'm going to use an aerospace equivalent. It would be like Boeing Aircraft and Spirit. And Spirit was Boeing at one point, then broke off and set up their own company and was supplying pretty much all Boeing parts, but Boeing has reacquired it because it came in trouble. Very similar to the TPI situation. Not that TPI was owned by an OEM, but it does sort of lend itself to GE Vernova designs are coming through TPI all the time, and a couple of the manufacturers for that matter. Somebody's got to do something. They need parts.
Yes, but here's the reality. And because I've actually studied a bunch of the different M&A deals that have happened in wind energy over the years. What happens in most industries with M&A is healthy company buys smaller, healthy but growing company. In wind energy, we don't really have that. When M&A happens, it's usually healthy company gobbles up assets of unhealthy company that are still valuable and then leaves the debt to somebody else. And that's why the Chapter 11 thing is interesting, because if they're restructuring the debt, it means they can reduce it a little, but the debt is still going to be there. If I'm going in and saying that the company's worth $7 million in a valuation, but they have $1 billion in debt, even after or during Chapter 11, I'm not buying it. Because who wants to absorb that? Nobody wants to do that. So the reality is what Joel mentioned, Are people going to watch while this thing falls on its face, and then out of the ashes of this, something new arises? Yes, I will actually agree with and support that notion. Not that I'm hoping TPI fails, but that's more likely to happen if the worst transpires and TPI can't pull themselves out of this. That is more likely to happen than some, angel investor or angel of an investor swoops in and grabs them up and says, you know what, we're gonna keep you healthy and keep you going because you've got this $1.6 billion order book. What we have in the wind industry are vultures who come in and they start plucking away at that $1.6 billion worth of order book and taking it for themselves. And, the remnants of that carcass can go, die in the desert somewhere.
No, here's my 30,000 foot view of TPI. I hope they can make this work. There's a lot of workers and a lot of the wind industry that relies upon them. They cannot close. They need to keep producing, and everything that's happening in the world right now with Ørsted is not great, but TPI has a bigger impact, I think, in terms of where we're going over the next 5 to 10 years. We need blades. TPI makes a lot of blades. They're pretty good at it, but the financial situation is just not good at the moment.
And keep in mind, too, that because of these changes in the law for production tax credits and investment tax credits, TPI needs to keep producing blades for now, which is one reason they were probably able to get this Oaktree Capital, financing to help them continue operating, because they have to make deliveries for anybody that's got turbines that they want to safe harbor before the IRS rules change, again, presumably at the end of this calendar year. We're about another 15 to 20 days away from seeing the first draft of whatever these IRS rules are going to be. I've already covered, ad nauseum.
I think it's the 18th or 20th. It's soon.
That's what I mean. It's supposed to be, within the next few days here, that we see a first draft. But just keep in mind that a first draft is not the adoption of the rules. So we're expecting that the final rules will be fully adopted by the end of the year. If you haven't safe harbored under the current rules, you need to do it now. That's, by the way, why Vestas just announced a 950 megawatt project in the U.S. They didn't say who, although if you want the details, contact us at Intel Store. We know. So, but the reality is anybody that needs to safe harbor turbines, it needs TPI, particularly GE or even Nordex if they're getting some of these blades from Mexico. Now that most of their quality issues, I think, have been worked out.
That's going to do it for this week's Uptime Wind Energy Podcast. Thanks for joining us. Check out our Uptime Tech News, where we talk about these subjects and a whole bunch more every week. It's free. Just Google Uptime Tech News and you'll get there. So we will see you next week here on the Uptime Wind Energy Podcast.